tax credit and tax deductions. They are not the same. But so many times when we hear tax credit, it's going over above your head and you don't really think of what does that mean. Tax deduction is a little bit more familiar because, of course, I deduct utilities and I deduct rent. I deduct payroll out of my income. So those are deductions, but credits is different. So I want to go through this hour and make that super clear to you so you become an expert and you know exactly what out there for our small businesses today. And before we begin, I always would like to introduce myself to you. I know some of you, I actually see new peoples every time I'm on webinar. No responsibility disclaimer. It is always a thing we need to make sure we let you know that it doesn't matter what we talked about on the webinar. When you really is going to use it for your own purposes, just be thoughtful and do more investigation and do consulting with us to make sure that it fit your needs, right? Maybe it sounds good, but come to you and it's not something that would help you. So just make sure that you don't peanut butter approach on everything we talked about. And we do sometimes give information, pretty soon it'll be outdated, right? It's particularly with 2020, so many acts coming through. And we said one thing in May and in July is expired. So information do move really fast and just be mindful about that. All right, so this is the business tax credit versus business tax deduction webinar. And let's just really understand the concept. Business tax credit tend to be used by the government sparingly because they want to use that powerful incentive to make something happen. Okay, people confused with deduction and credit. And let me just kind of give you a very good example. Tax credit, it is something government says, I do not take your tax dollars. If you are going to pay taxes, I'm going to use this tax credit offset your tax. Or sometimes government says, don't even need to offset because I know you don't have tax liability. I just going to give you that money. All right. So this is where the tax credit can become refundable. In some cases, refundable means that it is, even if you don't have taxes, it's still yours. Non-refundable means that only when you pay taxes, then you get the tax credit. So tax is already calculated, right? You could spend $10,000, you make $10,000 income, and if you have no deduction, the $10,000 comes in for tax calculation. Let's say your tax rate is 20%, then that's what? That is $2,000 for tax dollars. So tax credit only offset your tax dollars. But business tax deduction is different. If you made $10,000 income and the government said that this time you can deduct utility, I'm just making it up. You can deduct utility. Then you deduct the $10,000, you got $2,000 utility, you deduct $2,000, then you calculate taxes on the $8,000, right? So tax deduction is just reducing your income. It is only reduced a percentage of your taxes, but not the full amount, right? So this is a huge difference on concept, and I want you to really understand. So here on the slide, I said the main difference between a tax credit and a business tax deduction is that tax deductions are used to reduce taxable income, whereas a tax credit directly reduces your tax liability. Business tax credit is not the same as the deduction that is used to reduce taxable income. Deduction is just for income. Deduction against the income is related cost of goods sold and utility, mileage, and so on. So that is the kind of things we give you. Remember, the IRS always give you the mileage rate for the year. So that's deduction. The IRS said to calculate based on that rate so you can reduce your income, okay? And so here I have an example. The business tax deduction of $5,000 will only save the business a percentage of that $5,000 income. If a corporation is a 20% tax bracket, then the $5,000 deduction is only worth $1,000 in reduction of taxes, right? If the corporation qualifies for $5,000 tax credit, they are actually benefiting from the taxes. 5,000 divided by 20.2%. That's a 10,000. That's a let me do that. 5,000 divided, because the 5,000 is the tax dollar, right? If I divide that by my rate, so I'm reducing income by 25,000, not just the 5,000. See, the difference between tax credit and tax deduction is right there. Now we got it, right? Let's look at our next slide. So we will summarize the business tax credits for you. And really listen carefully, because this is so powerful. And I'm sitting here thinking that I guarantee any one of you who heard this webinar will identify some credit you forgot and you didn't know and you didn't claim. That is a huge loss if you did not claim the credit. If you didn't deduct some expenses, maybe it's not a big deal, because you may not really, it doesn't maybe generate that much of a difference, but tax credit is different. Business tax credit are the amount that company can subtract from tax owed to the government. Business tax credit are applied against tax you owe. Business apply for tax credit when they file their annual or quarterly tax returns. See, I said annual or quarterly tax returns. Let me tell you why. In the United States, IRS is the agency that supervises the refund, the tax credit portion of the business for the federal government. And now, remember this. So there is only two types of taxes. We're talking about tax credit: income tax, payroll tax. That's why I say annual and the quarterly, right? And then there's also refundable, non-refundable. We explained that to you, right? Refundable just means that regardless you pay taxes or not, you're going to get the money. And if you can relate to the personal tax return, how the earned income tax credit, you remember that one? That one, it doesn't matter you pay taxes or not, you get it, right? But it's called tax credit, is refundable. Non-refundable would mean that you have to pay taxes in order to get the taxes back. So a very good example would be historical tax credit. Some construction companies, and they did historical restoration for the building. So the government give them money to pay them back of the money. But that is a non-refundable, means that they have to pay federal taxes. So that portion of federal taxes will offset what tax credit the government is going to give you. But of course, you can carry that over if you say, well, I don't have any taxes. Now what am I going to do? I got this non-refundable tax credit is sitting on my book. Don't worry, you have 20 years to apply for it. But you just need to know that there is a non-refundable, refundable difference there. Okay, so every time you hear the word of tax credit, get excited, then figure out is it non-refundable or refundable. And knowing that it's only on the income tax arena and the payroll tax arena. All right. The first one I want to introduce to you is vaccination credit. Okay, this is the newest credit, came out from the White House. So under American Rescue Plan, and this is the plan that President Biden pushed out, right, when he became the president, the employers are entitled, like the business owners, are entitled to a refundable tax credit for providing paid leave to employees who take time off related to COVID-19 vaccination. So whether it's they go for vaccination or they are staying home, let's say if they went to vaccination and took half day a day off, and you know how much you paid for them, right? Say you paid $100. So my example, the employee who makes $100 per day and was off for 2 days due to sick related to COVID vaccination. So you go ahead, told the employee that don't worry, we pay for your salary, you go get a vaccination. So they did that and they took time off. And that $200 we're talking about, you will receive $200 back from your 941 tax return. Okay? $200 back from your taxes. So this is a tax credit. See how they are equal, how they are taking your expense, because your $200 expense reduce your income. And if a government just says that I'm giving you $200 back, and so you don't have to spend that money, and really you just reduce your income, and your income tax rate, if it is 20%, you only saved $40. But this is not. This is tax credit. That means that the real saving, and it is actually the 200 divided by 0.20, that give you $4,000 deduction. That's almost like you paid a $4,000 on expense. So that's a tax credit. All right, so that's our first one. You can get it back from your 941 quarterly return. Vaccination credit. The second one, healthcare tax credit. You may qualify for small business healthcare tax credit that could be worth up to 50% of the cost you paid for your employees' premium. Okay, but of course there's conditions in here. So I'm looking at the condition. I wish Community CPA could qualify for that, but we don't, because we got more than 25 full-time employees. So here you have, if you have fewer than 25 full-time employees, number one. Number two, if your average employee salary is $50,000 per year or less, your average salary is less or equals to $50,000 per year for divided by your employee, and you pay at least 50% of your full-time employee premium cost, and also you offer SHOP coverage to all of your full-time employees. SHOP coverage, it stands for Small Business Health Option Program. You automatically in that, if you buy your company health insurance through open market, you're actually automatically SHOP. So that is not really a huge consideration, but it's more of, number one, you need to have less than 25 employees. Number two, your average salary needs to be less than 50, and you need to pay 50% or more of the health premium. That's a lot of money. I mean, the health premium, right now we're going on the individual rate, and the one I know, people pay $400 per individual. That's a lot of money. And imagine you get 50% of that cost back. So it's almost like you only paid 25% of the employee's premium instead of 50. All right. So example, number of employees is 10, wages is 250,000 total in the year. So it's 25,000 each, right? The employer paid health premium of 70,000, tax credit amount 35,000. You get that back. If you got that taxes credit back, even this one is actually a non-refundable. So but if you don't pay taxes, you will just fold it. Eventually, when you pay taxes, you get it back. All right. So that is the huge tax credit people should look into. Then R&D tax credit. Yeah, want to make sure I didn't miss any. R&D tax credit. So this is also called increased research activity credit. Okay, this credit is generally allowed for expenses paid or incurred for qualified research. So you're probably sitting there goes, I don't know what I do for research. We have some medical practice companies are actually our clients, And June 2020, there's a lot of research going on, trying to come up with vaccine, trying to come up with solutions. And even the hand soap in 2020, there are researchers and trying to make sure the hand soap they mix is going to kill coronavirus. So all of that is a qualified research. So qualified research means the research expenses that are research experimental in nature are not capitalized. Not capitalized means that, let's say you're inventing this hand sanitizer, and you bought these medical liquid and plastic soap ingredients, and percentage of that mix can determine how effective your killing germs rate would be, right? So you're doing that experiment and you're spending money to buy those material, and you are expensing that out in your year of as your regular expense. You are not putting them on the balance sheet and thinking you're going to invent some patent and you're going to be having some right to this product you are trying to grow. And in that case, you can actually put that on the balance sheet, but you would not qualify for R&D. Okay, this research must be undertaken for discovering information that is technical in nature. Its application must be intended for use in developing a new or improved business component of the business. So, for example, I have a case where this particular manufacturing are meat packing plant. So they're packing up meat. So while they are packing up meat, and one piece of equipment they were experimenting is to have the seal. When they seal the packages, and it reduces the air in the seal. So when they purchase the equipment, it doesn't work. It doesn't work for particular size of packaging. So they are making new component, making it better. So that's improved business component. So that particular one, the people's salary, the equipment they bought, everything can be expensed, qualify for R&D tax credit. So now the research credit generally isn't allowed for the following type of activity. You see, I put this not allowed because there's a lot of people would have those kind of thinking, say, maybe I qualify. So let's look. So what is not allowed? Research conducted after the beginning of commercial production. So you got into production already, then you figure out something doesn't fit, and then you start doing research, and then that would not qualify for that production itself already, right? You cannot be pulling the production line back and deducting all the equipment and goes, well, that was my research. And so that they're saying you have to conduct the research prior to commercial production. Research adopting an existing product or process a particular customer's need. See, if it's for one customer's need, that's not research. That's called customization. You really need to charge a customer for what you're doing. It is not for some invention, right? And the duplication of an existing product process. Of course, that would not qualify. You're duplicating. You're not inventing. And survey or studies. Say I want to do some, Community CPA wants to survey the public to see how much they like us, and they don't like us. What should we do? And that is not research and development, right? That is really customer service, your CRM kind of thing. And the research relating to certain internal use of computer software. So, for example, if we are creating some kind of software so that when client calls and we know that who that is, and we can immediately see the client's picture on the computer, those are CRM process, and it is something related to your internal betterment. So they don't call that research. Research conducted outside of the United States. All right. So that tells you if you have scientists in China, in India, I'm sorry, R&D tax credit doesn't work. Okay. And research in social science, art, humanity. I'm just thinking that what would that be? Maybe researching percentage of homeless, what kind of money they need, and a survey and understanding of that. Sure, it is research, right? But it's not really qualified for this one. Research funded by other personal government, of course not. If you already got funded, and so those are, if you incur qualified clinical testing expenses related to drug, certain rare disease, you can elect to claim orphan drug credit. So there is other credit, which I didn't list it here because those are our regular small, medium-sized business. My clients are looking at the credit I'm talking about. And I don't really have a drug company who is my client, so I heard of the orphan drug credit, but I don't know how that works. It is a Form 8820 that they need to use. So example, 100,000 on supplies and 100,000 on payroll, and doing research on COVID sanitizing product. 6% of 200,000. This is the total expense, right? 6%, that's what the government allow you to take the tax credit. So that gives you $12,000 credit that you can get that refunded. And it says non-refundable tax credit. It just means that if you didn't pay taxes, you're just not going to get the money. But if you don't pay taxes, you don't get money, it doesn't get lost. It's actually got saved for you, so you can use it later. And so I put in here saying that equivalent to the 6% is the 30% of the expense, because that is 60K deduction, and the 30% of expenses related to R&D are refunded by federal government, GOV. Forgive my, yeah. So that's where I want you to kind of understand, right? 6% of your expenses that calculated to be your tax credit, that's 12,000. That equivalent to, if you are paying, if your tax rate is 20%, I think I used 20%, then it's 60,000 of your 200,000 is literally paid by the federal government. So you are actually, so it's a 30% of your expense is getting paid back. So that's the power of R&D tax credit. Now, work opportunity tax credit. I bet you, and everyone who is listening to this webinar today, you can do this. And if you don't even know what that is, I'm sorry, you are losing out. It is not like the government don't give you benefit, you just don't care to get it, okay? So what is work opportunity tax credit? This is a federal tax credit available to employers, to entrepreneurs, to the business owners for hiring individuals from a certain targeted group who have consistently faced significant barriers to employment. So there's a couple of categories and it belongs to there I want to bring to your attention. Okay, so the number one is qualified. I don't know what IV-A recipient stands for, but it is this. It is qualified long-term recipients, temporary assistance for needy family. So there is a TANF family, and they are the one receiving the government welfare in general. Like if you got your food stamp, you're probably one of those people. If you hire someone like that, and you can get this tax credit. And qualified veterans, you can get tax credit. Ex-felon and those who come out of the jail and restarting their life, you hire them into your company. Yes, you qualify for this tax credit. And the designated community residents. And I give you this definition right here. Designated community resident is 18 to 39-year-old and live in the rural, renewal, county, or empowerment zone. A summer youth employee, the summer student between 8 and 16, 17 lives in empowerment zone and works between May 1st and September 15th, price for tax credit. I give you an example of how to calculate that, but just follow me. And also rehabilitation referrals, people who come out of disability, okay? And some are used and listed them separately because I want you to know that, if you hire someone from May to September 15, the wages you pay to that person, look what happens to that wages. It says 25% of the wages paid to the person, okay, it is the credit. So let's say it is 10,000 wages. 25% of 10,000 is what? Is 2,500 tax credit, right? It is not refundable, just means that if you don't pay taxes, they don't give you, but you still have it. Later on, when you pay taxes, it will come out to rescue you like a hero, okay? And that 2,500 tax credit equals to $10,000 expenses in your accounting book, in your payroll expense. So you paid the student 10,000, you literally get $10,000 back. You literally did not pay them because of this tax credit. Does that make sense? Make a lot of sense, right? Because the tax credit is calculating the 12,000, the 2,500 they give you is offsetting the tax dollars. When you get the tax dollars come out, you owe money to the government. That's because your $10,000 expenses is not expenses is equivalent to the $2,500 tax credit. If the government says you don't have to pay this $2,500, you got my credit, that means they allow you to wipe out the $10,000 payroll, and then you just paid the student $10,000, so you got it all back. That means in the summer you hire someone work for you for free. Why are you not doing that? Why are you not looking at work opportunity tax credit? And I also have someone, they're one of their siblings, one of the business owners, they're one of their siblings is coming out of jail. And as a brother, as a brother of that person, he wants to bring that person in. And so with that ex-felon status, he can get 25% of that salary paid. Isn't that cool? Okay, so just make sure and you know what that credit is all about. And I know those are things sometimes you felt like, I by myself as a business owner, we can do everything by ourselves, right? So you think that I by myself, I'm not gonna be able to do that. Come on, Ying, there's so many little things. This is where I would say that you really do want to tie your business with someone is definitely can help you. Find a CPA firm that you feel good about and go with them and have them help you with all of these things I'm talking about. Sometimes it is just you questioning that. And you don't need to do that. You just come out and say, look, I hired a summer student. Do you think I qualify for work opportunity tax credit? And that question alone would make your tax preparer and your CPA to think for you. And at our firm, and we regularly review those tax credits. It's on our checklist. When you work with us, and we actually have a checklist on the side, and we will qualify you for things that you do. That's why we, our folks always say that we do a lot of things for our clients. Sometimes we didn't even bother to tell them because we just do. But you want to find that kind of firm who just do, because you could be benefited a lot. All right. So our next one, employee retention credit. This is a really good summary, folks. If you got so confused with the ERC credit, okay, you don't really know what you should do, take a picture of this slide. And I'm going to read it out to you because some of our folks, they listen to our webinar. They got tired looking at me because I have nothing fun to show them. So they just turn on the YouTube, they listen to me. So I want to read this out to you because it is so precise. It gives you took all the noises out, and this is exactly what you're looking for. The ERC credit, begun on March 12, 2020, was originally set to expire at the end of 2020. Then before President Trump left the White House, and he has this Consolidated Appropriation Act, it's called the CAA Act 2021, that extended the ERC credit through the first half of 2021, so the first quarter and the second quarter. Then President Biden came on board, and he extended that again to the third and fourth quarter of 2021. So ERC credit is available to you starting from March 12, 2020, all the way to December 31st, 2021. Okay, so that covers how many quarters, folks? That covers 8 quarters. The first quarter on March 12th, that's a short quarter. Okay, so just remember that covers 8 quarters. The ERC credit is an offset to employers' share of Social Security tax. Okay, and after the second quarter of 2021, the government allowed the Medicare taxes also come into offset. But just keep in mind, it is your employer portion of Social Security Medicare tax. The employer portion of Social Security tax is how much? Is 6.7%, right? So you will file that with your 941. That is why it is on 941, it's not on your corporate income tax return. So you get money from your 941, which means you'll pay less money to 941. If you overpay, they give you the check back. All right, rule for 2020, 50% drop in income and or partial shutdown. Or shutdown. So condition, 50% drop, shutdown, partial shutdown, then you can get 50% of the 10K being maximum. So if you pay your employee, $2,000, $2,500 a quarter, then that's 4 quarters, right? You can take 50% of that and get credit back. And for 2021, quarter 1 and quarter 2 is 20% drop. You can get 70% of the 10K per employee. If you have an employee who you pay 10K in 1 quarter, then you get $7,000 back. Of course, your sales must be dropping 20% from where? Dropping from 2019. Okay? The last rule for quarter 3 and 4 of 2021 is a 90% drop. Okay? Then you got 70% of 10K. Got it? So that is the ERC credit. And we have quite a few. We actually have a good webinars on our website, on the YouTube site about ERC credit, how to claim. We literally get into the trenches to really teach you exactly how you do it. We call that do it yourself webinar. And we have a lot of questions coming from folks, and there are people ending up just give the whole cases to us. Okay, Community CPA, help us to do that. And we do that. So if you get into hot water like that, just don't know what to do, and your payroll processor just, tell you that, no, we don't want to help you, we're too busy, then, you have us. And we always do our very best to make sure that we help you. And this ERC credit does have a long due date. So it's not like due tomorrow, and you have a year and a half to work on that. But I would not bet on that, because there's reform coming through this October. If they shrink that and give a due date, and so the business folks need to hurry up and don't wait on that. Okay, so there is a ERC credit not related to what I was talking about, related to natural disaster of any other kind. So this is also called ERC credit, but it has a credit amount different from what we were talking about. That was the coronavirus related ERC credit. This is what we called 5884 ERC credit. It is a normal ERC credit when you experience natural disaster like the fires in California, earthquake and things like that, and you qualify for that. So when you think of ERC, don't think that it's just now. In the future, when you have any disaster happens, as long as it's been declared federally, and you would qualify for this ERC. And the credit is 40% of qualified wages up to 6,000 for a maximum credit of 2,400 per employee. There's no limit on number of employees for whom you can claim this credit. Okay, so the deduction for compensation is reduced by the amount of credit, like other income tax credits. So basically, what they're saying is that don't double dip, right? If you already deducted, if you already got credit for example, if you got coronavirus ERC credit already, even if you come through another tornadoes, add on top of the coronavirus one, and you don't want to double dip. So that is really, really important. So at the end, we say that coordination of your credit, you can't be claiming salary on R&D credit, then turn around, do your ERC credit, and then turn around, get your PPP forgiven. So be really mindful. Don't use federal credit twice. It is only meant to be once. That is why sometimes people, would contact us, goes, oh no, I know for sure I qualify for this. And then we will be like, okay, did you have PPP? Oh yes, I also have PPP. That's why you don't qualify for ERC. So there are things like that, and just really relying on your knowledge that you gain through these webinars. At the same time, really, if you are going to grow your business, you have to tie your relationship with a professional firm like Community CPA to really be, be in the know to what's going on, right? So that's really important. I always say that, in order to really scale in business, you must have a good business partner. When I say business partner, I don't mean that to share profit with you or to be your real subtracting, adding kind of partner. It is the partner that you supplement each other. So you need a good CPA to be there for you. And we also provide what we call fractional CFO services to our client. Sometimes our client has accountant, in-house. They do good jobs on their books, but come to higher level of managing and they are lacking, so they would hire our firm to provide fractional CFO service. Then we come in and look at things at a high order, just like these credit. We go through the credit and we make sure that we take advantage of everything that is available to small businesses, right? All right. So credit for employer tax paid on tips. This is a old credit. This is credit that every restaurant owner should know it inside out. It's elementary school level of credit, and you got to know, right? So that is the form 8846. And if you are a restaurant owner and you file your restaurant business under your 1040, for example, if you have S corp or partnership, they go through K1 coming to your 1040. As long as they show up on your 1040 and you don't see that form on your tax return, I would question your tax preparer. Okay. And of course, you have to meet conditions in order to get that credit. 2 conditions. Number 1, you had employees who received tips from customer for providing, delivering, or serving food beverages for consumption. If tipping for the employee, it is a customary ways of that service. Okay. If tipping is not really the thing, then you can't, right? So for example, someone, there was one time one of my client, she actually works in the eyeglasses stores. So she got a tip. She got a $500 tip from a customer, but that is not really customary for that industry. So the employer cannot claim that tips credit. So it is only has to be, the word they use is customary in your business. During the tax year, the number 2 condition is that you paid or incurred employer Social Security, Medicare taxes on those tips. So let's say if your employee just pocketed the tips and didn't tell you, and you don't know, and you did not pay Social Security, Medicare, then you cannot have this tips credit. So only when you get that tips into the paycheck and calculating on the Social Security, Medicare, so you would pay for it, that is the credit is the portion of what you paid for. So it just because IRS really thinks that it is not fair for the restaurant owner to pay on the tips for Social Security, Medicare, because you have no control. Some customer come around, pay $3,000 tips. What are you gonna do? And you are going to pay close to 8% of that 3,000. So you pay a lot on that taxes, and it is not under your control. So the IRS allow you to take your $240 back. Okay, so that would be your credit. So this is the spirit, the idea behind that. Of course, there's more. So one I want to mention, because more and more of my clients are doing those kind of things. Don't forget that you can actually claim the pension and the 401k sort of setup for $5,000 tax credit per year for 3 years. Just don't forget, okay? And if there's a $500 more, so you could claim up to $5,500 if something happened. I don't remember that another $500 is what, but at a minimum, you can get $15,000 tax credit to your pocket. All right. And credit for employer provided childcare. That just means that if your company and has all the moms working for you, and you have the passion to help the moms to take care of their baby, so you set up daycare, and that expense has a tax credit. And someone was asking me, what about puppies? Because puppies is just as important as children, and our company providing dog daycares, and does that qualify? Well, I always say to folks that it would qualify if the puppy can get Social Security number. That would be the hurdle we have to overcome. Otherwise, yes, you can have the credit. Solar incentives is also a tax credit. I just want you to see my example, okay? So let's say a business made $100,000 in solar investment. Means they bought a $100,000 solar panel, okay, and installed it, and that would offset federal tax bill by $26,000 in the first year alone. So this goes on to number of years, but first year alone they did that. So if someone has 35% income tax rate, if you are paying 35% of income tax rate, the federal government is literally paying $74,000 to you for that investment you made of $100,000. That is the 26% of tax credit thing. So basically, you invested $100,000 on solar panel. The government actually give you $74,000 out of back to you, saying that, oh, great job, and you only need to spend $26,000 for your $100,000 because the government give you the tax credit back. Of course, this tax credit needs to offset the tax liability you have. So if you don't have tax liability, you still did that, and then your tax liability will just your credit just gonna sit there, wait for you. Okay, so that is the solar incentives. So we covered quite a few tax credit, right? So now let's go to the tax deduction. This part is easy and is no big deal. We all know what we deduct. And one thing I do want to mention to you. So business expenses are the cost of carrying on the trade and business you are in, right? And these expenses are usually deductible. And if the business is operating to make a profit. And these languages is not me just coming up with Chinglish and giving you the language. These are completely coming out of the IRS website. So you notice that when you run a business and you maybe you don't make money in the very beginning, but your intention is always to make money, right? As long as you have that intention, as long as that's your goal, and you can deduct your business expense, it needs to be ordinary and necessary. Ordinary means that cannot be so odd. It's like why, right? So you got to be able to articulate that is, that is what customarily my industry would do. Okay, and necessary. Necessary doesn't mean has to be desperately you must need. Like in the restaurant, necessary is my cost of sold. I of course need to buy onions in order to cook. So no, that is not necessary. Necessary, it is not necessary doesn't equal to you must have. Necessary means that it will be helpful. Okay, so there is much broader, is much more loose than just cost of sold. So the expenses used to figure the cost of sold, that's part of your expense. Capital expense, personal expense, no. Personal expense is really not a business expense deduction. So don't try that. And if you do have personal expense, say you did a trip and to go for a training seminar and you went to Hawaii. And your seminar time was 5 days, but you stayed for 10 days. So in this case, I would separate my travel expense 50-50 because I had 5 days, enjoyment. Then I did do business and do trainings and learnings for the other 5 days. So make sure your divide is reasonable to IRS. I only say that because I work with a lot of IRS auditors, and in working with them, it is really clear that they're looking at being reasonable. If in their eyes it is not reasonable, what they do is they will deny your deduction. That just means your income will increase. Then you will end up paying more taxes, and with penalty and interest is double. So it is not good when you try to deduct expenses that you already know that's dangerous, because I can guarantee you after pandemic, and one of the business will increase at IRS is audit. They will try to audit because audit is one of the biggest way. I wouldn't say biggest way. It's a big way for IRS to get money back from the taxpayer. All right. When can I deduct expense? Deduct expense, two basic, when can I deduct expense? When you can deduct expense depends on the accounting method, right? Cash method, generally, you deduct business expenses in the tax year you paid them, right? Accrue method, you can deduct once all event has occurred, and that fix the fact of liability, and the liability can be determined with reasonable accuracy. Economic performance has occurred. So yes, so basically when you for accrue method, and means that you may not even make the payment yet, but all of your purchases are already producing economic results, then you should be able to deduct it because your accounting method is accrual. Accrual just means that the income you did not receive yet, you would report. The expenses you haven't really paid yet, you could deduct. But it goes on both ways, right? So you cannot be saying that, oh, my income is cash method. Whenever I receive one, I count. Whenever I don't receive one, I pretend I didn't have it. And then expenses I go on through because I always wanted it early. So that's not right. And that you really should do the method for both ends. Sometimes for certain industry, for example, grocery stores, okay? And grocery stores, your customer coming in to buy, then how can you do accrual on income? You can't, because you don't know which customer gonna pay you what, right? So even though you are accrue method, you would actually do your income on cash by fact, by default, by natural of business. You just can't. You have no way to accrue your income, okay? But your expense, if you are on accrue method for a grocery store, and if you have that, if you purchase some inventory that is net 30 days, on December 31st, you haven't paid it yet. If you haven't paid it yet, you're on accrue method, you actually can deduct that, right? Because you already sold it. But if you're on cash method, sorry, it didn't come out of your bank, so you cannot deduct it, right? So if I am a grocery business, I didn't know why I would be in cash method. It doesn't make any sense for people to be on cash method. But you know what? There are a lot of people on cash method because the tax software that your tax preparers are using, they default everything on cash. So if they don't really understand this part of the thinking, they don't touch it. It's on the tax form page 2. So people don't even look at that because they're more into the first page income expenses, the last page balance sheet. In between, they just forgot to look at it. So they didn't really make determination for you. You defaulted on the cash method. Then you may say, well, Ying, what's going to happen? If I am defaulted on cash method, I want to be accrued. Then you have to change your accounting method. That's a special request to IRS. It's not automatically becoming another way by just whatever you want. So you need to go through that process to apply. All right. Now we're on the common types of business expense. Of course, employees' payroll, retirement plan is business expense. Rent expense, interest, taxes, insurance, and I'm not talking about income taxes here. This is your sales tax. This is your property tax. This is the taxes that you are paying for your business, right? Not the income taxes that at the end you are paying. Or for C corporation, that's the taxes that C corporation is paying. That's not a expense. All right. Questions on other deductions? So I want to introduce to you this IRS website. This is publication 535. You know, one of the tricks when you go on the IRS website, I know it is very overwhelming because you get a lot of information. But if you go to publication 535 and just look at the table of content, IRS really do have very good table of content. So if you have questions related to motor vehicle deduction and you go there, it will list it there. Then you click on that table of content, then it will lead you to the content that's just for you. And don't try to, do a general search on IRS website. It doesn't work very well. You really need to know the publication. So I am giving you that publication for you to look at. All right. My goodness. And a very quick 1 hour, right? We're almost there. And just to remind you, follow us on YouTube. And this webinar itself is on YouTube for you in 24 hours. So you can find me there. And my next webinar on Saturday, I'm thinking of talking about Schedule F and a farm, everything about farm and the farmers. And I was thinking, how boring it can be for me to sit here. And today I'm in Bloomington. If you don't recognize my background, by the way, I don't use the virtual background because I want you to know that I'm real and I'm in the real place. I'm in Bloomington, which is our Community CPA's 3rd branch. And yeah, Bloomington is a great place. I'm very close to Mall of America right now. So that's where you see I am. But next Saturday, I'll be in a farm called Happy Valley Farm. And, that farm, I was trying to think that I'll be on the farm and talk to you about farm. Wouldn't that be cool? So that would give you a little bit of pleasure other than just listen to my material and in case you get bored. I hope not. I hope you really learned a lot from this conversation. And I welcome you again. On Tuesday, I have 30 minutes. And on Saturday, I do topics just like this. And just kind of, just give to you. And hopefully you clicked with what I was talking about. And I'll see you again. Bye-bye.